Most people don't like the idea of paying for traditional long-term care insurance. And honestly, I get it. You pay premiums for decades, and if you're fortunate enough to not need care, that money doesn't come back to you. Use it or lose it. Here's what you may not know. There is an alternative. It's called a hybrid policy. And today, I'm going to break down how it works, who it may be right for, and what you need to consider. First, let's talk about why this conversation is so important. If you're turning 65 this year, studies suggest you have a nearly 70% chance of needing some form of long-term care during your lifetime. That's a significant consideration, and the costs can add up. We're talking anywhere from about $2,000 a month for adult daycare services to upward of $10,000 a month for round-the-clock nursing facility care. And the average long-term care need lasts 2 to 4 years. Here's what many people don't realize. Health insurance typically doesn't cover this. Medicare only covers a maximum of 100 days of skilled nursing services after qualifying hospital stay. So the question becomes, how do you plan for this? A hybrid policy combines life insurance with long-term care benefits into one product. Instead of maintaining separate policies, you get both types of coverage in one single package. Here's the key difference. With traditional long-term care insurance, if you don't use it, you don't receive anything back. With a hybrid policy, your premiums can work for you in more than one way. If you need long-term care, the policy provides access to those specific benefits. If you don't, it still functions as life insurance for your beneficiaries. Either way, there's potential value all around. Let me walk you through some of the potential advantages. First, predictable premiums. With a standalone long-term care insurance, your premiums can increase over time, sometimes significantly. Hybrid policies typically lock in your rate. That can provide stability in your long-term care financial planning. Second, flexibility. You're not betting on whether you'll need care. Either you use the long-term care benefits or your loved ones receive the death benefit. Your premiums go towards something meaningful. Third, it can work as part of an estate planning strategy. The long-term care coverages may help protect the assets you want to pass on to the future generation for being used for care costs. Now let's talk about the trade-offs, because every financial tool has them. First, higher upfront costs. Hybrid policies tend to be more expensive than buying either a traditional life insurance policy or a standalone long-term care policy separately. You're paying for the convenience and bundled benefits. Second, less customization. Standalone long-term care policies let you tailor specific features like coverage, duration, or inflation protection to your needs. Hybrid policies typically offer fewer options to fine-tune them. Third, reduced death benefit. If you use the long-term care portion of the policy, it reduces what's ultimately paid to your heirs. The more you use for care, the smaller the remaining death benefit. So here's the bottom line. Hybrid life insurance and long-term care policies can be a solution worth considering for people who want to cover it without the use or lose it concept. But like any financial tool, they come with trade-offs. The approach that fits your needs depends on the long-term goals, your budget, and the type of protection you want in place. Our team is here to walk you through the options and help you explore what may work for your financial future. Thanks for tuning in.